Welcome to Noble, a network of owners, business leaders, and entrepreneurs. Here, we focus on the 5 stages of business: launching an idea, establishing a business, hiring employees, creating leaders, and then expanding your impact. We hope you enjoy today's session.
Hacker again. Thanks, Jeff, for Jeff is on the inner circle. He knows how to pronounce my last name. Most people say Acer, but again, Jeff and I have gone way back decades or more now. And today I've been asked to talk about one aspect of financial planning. So we are a wealth planning or financial planning firm, Concordia Wealth Planning. Investing is one piece of that. So the way we do investing at Concordia is what I've been asked to speak about. Just want to start with this. As Jeff mentioned, if we're doing things God's way, we realize and understand that money is not the end goal. The world tells us that money is the end goal, accumulating wealth is the end goal, but money is just a tool to help you achieve your priorities in life. There are 4 uses of money, and again, this is a slide taken from Ron Blue and Faith Finance. There's different resources that I can point to, but God really does own it all. You see that at the top there. But the different categories or uses of money: live, give, owe, and grow. Living is really just the spending and lifestyle. Giving is through generosity and community impact. Owing can be in debt and taxes. And then growing is the piece we're going to talk about today, is saving and investing. Investing is simply for longer term or future use of those dollars. So that's what we're going to dig into. The biblical responsible investing, you probably saw this on the invite, but biblical, I'm just going to define it, is BRI aligns financial goals with faith-based principles. It integrates biblical values into investment decisions. BRI seeks to steward financial resources in accordance with religious beliefs and personal convictions. By prioritizing values alongside returns, BRI offers investors the opportunity to make a positive impact while pursuing financial growth. So you probably saw that definition along with the invite for today's session. But that's really where we are going to go and dig a little bit deeper. Before we do that, I don't know everybody who's going to be listening in or everybody that's on today and kind of their background knowledge in investing. So I just wanted to share some slides that we do with all of our clients. We like to educate our clients. What is investing in general? We'll use this illustration. We've used it hundreds of times. The idea of ownership in a house to understand stock and bonds or equity and debt. And for this illustration, I know there's no houses out there that are $100,000 anymore, but we'll just call this a $100,000 house. If you were to buy a house, you likely have to put 10% down or $10,000 down to buy a $100,000 home. The rest of it is financed through a mortgage company or bank. So 90% or $90,000 is debt that is owed back to somebody. So in the equity portion, if you own stock in the house or equity in the home, and the house goes from $100,000 and increases in value over, say, 3 years to $200,000, well, you now have $110,000 in equity in the home. Let's just say you were paying just the interest on that debt. So that $100,000 house becomes $200,000. Maybe it's locally here in Columbus, Ohio. We've seen prices skyrocket as most of the country has. But you now own your $10,000 became $110,000. So that appreciation in the value of that asset, of that home, is what you got to enjoy the ride of, or your money got to multiply by the equity or ownership in the home. When you go to sell that home, that's now $200,000, you still owe that $90,000 back. So you've paid fixed interest, you've paid the interest on that bond back to the mortgage lender. So that portion has to be paid back, and you now net the $110,000. Similar to ownership in a home, you can own both stocks or bonds in companies. So instead of a house being the asset, if the company was the asset, you can either own stock and get some of the appreciation or depreciation that $100,000 house doesn't have to double to 200,000. It could go down to 90,000, and then your 10,000 became zero. You still owe that debt, that $90,000 back, but your equity or your stock became zero. You can own stock in companies, and it will appreciate or depreciate in value, or companies do offer bond. They offer debt to people, and you can buy as an investor. You can buy stock in the company, or you can buy their debt and get that fixed income or interest paid back. So really, when you've heard the term investing, it's primarily in stocks and bonds that you're looking at in the public markets. And so you're either buying ownership in the company or you're buying their debt so they can use that to expand their business. That's just a brief kind of understanding of how you can use your dollars in an investing manner. Why invest? These are a lot of squiggly lines on here, and this goes back to 1922. I'm just going to highlight a few of these lines. The orange line is bonds. So we talked about stocks and bonds, but if you invested $1 in government bonds and earned an average of 5.2% over the period until 2022, that $1 becomes $131. So you beat inflation. Inflation is this gray area here. So one of the goals of investing is to beat inflation. Bonds do beat inflation. So over time, it's beat inflation. But if you had invested in stocks, let's look at the lighter blue line. This one down here is the large company stocks. On average, earn about 10%. There's a lot more wiggle, a lot more up and down. It's a bumpier ride. But that $1 becomes $11,535. If you invested in small company stocks, it's the dark blue line. There's a lot more ups and downs, and it's a bumpier ride yet, but that $1 becomes $49,052. So that the slide here is just to illustrate that stocks outperform bonds often and by a lot. Bonds do outperform inflation. You beat inflation. That's one of your enemies of investing is inflation. So bonds do outperform inflation. But if you have time on your side, investing in the stock market is going to be better for you than the bond market. One other point to make here is any 10-year period. So if we'll look at the next slide as well, but any 10-year period here between these two lines, there really has been no loss. There's a lot of loss. You've probably felt it in 2022 if you were invested in stocks and bonds. It was a terrible year for investors. But any 1 year, there could be down market returns. But any 10-year period or plus or more, the markets have been on your side when you're investing in stocks. This slide here really illustrates that in a different manner. So time is how you reduce risk in the investment world. One of the ways to reduce risk is time. So if you have time on your side, as this illustrates here, in any given 1 year period, that light blue, small company stocks can be down over 50%. You lose over half of your investment dollars. They can be up over 125%, close to 150% in any given 1 year period in time. So it fluctuates a lot. When you look at the 5-year in green, the variance is a lot tighter. There's still room for loss, 25% down or close to 50% up in small company stocks. But when you look out over a 20-year period turn, they average 11.8%, almost 12% on average. There's no loss potential because time has reduced the investment risk over that time. Now, if you look at any of these other charts here, you got large company stocks. There's 1 year, there's less chance of loss, but you also don't take as much risk, and there's less reward on the upside. But any of these charts here, if you look at that red box, whether it's stocks or bonds, to the right here, treasury bills being more like cash. Cash has really no loss over those period of time. You're losing to inflation potentially, but no loss of those actual dollars. But 20-year periods, if you have 10 plus years on your side, investing in the stocks, again, stocks outperform bonds often by a lot. You want to be mostly invested in stocks. Drivers of investment results. So one way I want to use this chart is to say, is my security selection or which companies or which mutual funds or which ETFs that I purchase, Is that really what is the driver of my investment results? This chart and the study that backs it up says no, about 5% of returns are driven by security selection. Less than 2% is driven by market timing. I believe, and we believe, that market timing is impossible. Getting in and out of the markets in a perfect fashion is impossible. Even in a good manner is impossible. If you miss up market returns, you're going to be behind. It's really two timing decisions that you have to make: when to get out and when to get back in. One of those is impossible to make perfectly. Two, it makes it even more impossible. Asset allocation, this orange piece, is over 90% of your actual investment return. So asset allocation, meaning how much stocks versus how much bonds do you own in your investment portfolio, or do you own in your account? So the real big decision for any investor is how much stocks and how much bonds to invest in. We'll get into other decisions as we talk about more biblical responsible investing. Just wanted to give an education over investing in general. Stocks versus bonds. The efficient frontier, if you've taken finance courses in college, probably not in high school, but you've probably heard about the efficient frontier. It's at any point along this curve, you are increasing risk with adding stocks and bonds to your investment portfolio, but you're also increasing on the left-hand side your expected return. 100% cash, you're not expecting much return back from that. These days, cash is paying 5% or more, which is we haven't seen in the past decade. But as you increase above this, add bonds to the portfolio or add stocks, you are said to be on the efficient frontier when you have a good mixture of stocks and bonds. 100% stocks, you're the most risky portfolio, but you also have the greatest expected return. Anywhere along this sliding scale, or this efficient frontier, you can mix how much stocks and how much bonds. Again, that's going to drive your asset allocation. Stocks versus bonds is going to drive your investment expected return. One way to illustrate that here, the 60-40 portfolio is the most common balanced portfolio. If you can almost cut your risk in half by adding 40% bonds to your portfolio. The expected return, as you can see on this left-hand side, doesn't go down by half. So your risk has been reduced by half, but your expected return has gone down slightly. In the 100% bond portfolio, many people stepping into retirement, pre-retirees ask, should I be 100% fixed income and bonds and just live off the income? Our answer to that is always no. If we haven't done a good job of educating our clients, we will tell them you can increase your expected return by adding stocks to your portfolio and get it on the efficient frontier and have an efficient portfolio, or you can reduce your risk and keep the same amount of expected return that you want by adding some stocks to the portfolio. So we always do believe that there is some sort of balance between stocks and bonds that is necessary or needed to be on the efficient frontier. So 100% bond portfolio for pre-retirees, retirees really doesn't make sense when you look at the studies behind it. Another thing to think about, so that we talk about buckets of time often with our clients, is your time frame. 5 years plus should be in these growth assets. That's stocks, bonds, real estate, anything that's riskier. 5 years plus. Again, we looked at that 10-year plus numbers, the 20-year plus. You reduce risk if you have a time on your side. Anything that's within the first year, especially for retirees, 1 to 2 years, should be in cash or something very short term. It should be safe. You want to put $1 in and get $1 back out. Fixed income, again, this is the bond bucket. For those retirees that are worried about running out of money and worried about stock market crashes, when we look at their overall portfolio, we look at, do you have enough cash to get you through the first year or two? Do you have enough bonds to get you through the next 2 to 3 years? Everything else could be invested in the stock market. Doesn't mean it should be in everybody's situation, but we always talk about this buckets of time to give people some comfort in how they are invested. The other questions that we ask, because we're planners first, is what is the time horizon and purpose of those dollars? So we segment money into buckets of time. It's a helpful tool. Can you emotionally tolerate a quarter or a year lower of asset value? So if your stock account is fluctuating, can you emotionally tolerate that? Emotions is one of the things that's a investment killer, getting your emotions involved. And then what are my income cash flow needs? These are all planning questions that we ask because we're planners, talking about investments today. And do I have future tax issues? Again, in this little green tagline here, it's about time in the market, how much time you have on your side versus timing the market, because it's impossible to do. When we look at asset allocation, I think this is my last slide on that topic, we have different investment portfolios. So you can pick 100% equity, 100% stock, and you're going to have an expected return of around the market-like returns, 11.1%, volatility, which is the risk, of 16.2%, and then a range of returns of negative, in any one given year, to any positive returns. And you can see these different ranges. So as you add more bonds to the portfolio, your expected return goes down, but your expected risk also goes down. So you can de-risk your portfolio with time and adding a balance of fixed income or bonds to the portfolio. So if you ever worked with an investment advisor, you probably looked at different models like this. I mentioned emotional investing. To the killer of your investment portfolio a lot of times is your emotions. So as optimism increases, excitement, you see the markets going up, you see certain names, certain companies that are in the tech world, or in the self-driving automobile world, or whatever it may be. You want to get on board that train, and that excitement and the thrill and euphoria is the time when you've probably heard of sell high and buy low. It doesn't feel good to be doing that. Most people are still buying at those high points because there's that euphoria in the market and the media is all talking about it. So if you can avoid buying high and selling low, as most people end up doing because they follow their emotions, you're going to be a more successful investor. These are 3 D's that you can maybe take away, but being disciplined and staying with your long-term objective. Again, having a plan, avoiding the emotional mistakes, being diversified. Don't putting all your eggs in one basket. You've heard that said before. That's a very biblical concept. A lot of things that people take in investing are from the Bible, but don't putting all eggs in one basket is one of those. Dollar cost averaging, automating your investing as part of cash flow. You do that probably naturally, normally in your 401k, but if you can do that in other ways as well, the more you can automate things, the more successful investor you're going to be. Let's shift gears to biblical responsible investing. This is why I was asked to speak today. This is why everybody came to hear something different. We do try to do things in a God-honoring way. It's also called faith-based investing or values-based investing. So you may kind of hear these terms differently, but we're using biblical responsible investing, or BRI, today. 3 different investing strategies for BRI is avoiding, embracing, or engaging. The most common one you'll probably hear people talk about is avoiding. What do I want to screen out or not own in my portfolio? This is really the one that first was introduced to me 6 or 7 years ago. I didn't realize certain companies that I invested in because I had a broad index fund that I had invested in. An index fund is one that owns lots of companies in a certain basket of the index or the stock market, and it owns little pieces of each one of those companies. I did not know that I owned certain companies. As this was highlighted to me, I started asking the question, are there different ways to invest? Are there ways that I can avoid companies? And I have found out there are ways. There's no perfect way to invest, but I do believe there are better ways or more God-honoring ways to invest. The second one down is embracing. So instead of just avoiding companies that you're trying to cut out of your investment portfolio, what are companies that are really making the world a better place? They're providing a product or a service that is beneficial to our community around us, beneficial to the world around us, beneficial to human population in general. So embracing or adding to your investment portfolio certain companies that align with your values. And then the last one there, engage. Engage is a much more difficult one to build into a portfolio, but a lot of this is based on voting through proxies, shareholder proposals. There are very small owners in companies like ExxonMobil and some of these oil companies, very small shareholders that have had a huge voice and changing their business model because they've engaged. The question that many people that I've in the Christian space that are asking is, how can we, as sometimes small owners in these companies, engage in the boards and based on voting and have an impact, even if we're a minority, as it seems like we are becoming more and more of. So on the avoid topic, I'm going to just go into some of those specific areas, and these are based on Bright Lights research. Which ones are most often screened out. We do have a way of customizing portfolios for people. So there are certain investment funds, mutual funds, and ETFs that have their own kind of philosophy around investing in the biblical responsible space. But you can also customize, for your own values. But abortion, pornography, tobacco, gambling, alcohol, stem cell research, weapons, contraceptives, military weapons or controversial weapons, cannabis, child labor. These are things that people ask about excluding from their investments and screening for in their investments. So from the left to the right, the ones that are most often screened for. This is a list of companies on the left-hand side that are out there that are doing some of this work in the investment space that provide mutual funds and ETFs. We use this screening tool, I guess, the spreadsheet to help us identify, kind of funds and managers that we would align with in our portfolios. But as you can see, there's Eventide, Crossmark, Timothy Plan, Praxis, Inspire, Guidestone, Ave Maria Funds, One Ascent, Global X. They have a Catholic Values Fund that we use. All of these down the list are funds that we're monitoring and encouraging those in the investment space to continue to increase dollars toward biblical responsible investing. Because there's one company that talks about, investing in what makes the world rejoice. If we have more and more people willing to do that with their dollars and thinking about doing that with their dollars, then it's going to get all these things that people are trying to avoid are not going to be attractive to investment dollars and investors, because we're going to be pulling dollars out of those certain areas, adult entertainment and alcohol, tobacco. Again, whatever your beliefs personally are about those, there's differences in how these companies even screen for them. So you can kind of customize your own approach, but just being aware that there are different ways to invest was powerful for me alone. This is one of the funds that we use in our portfolios, but understanding what each fund does differently is important. So this fund has exposure less than, each fund looks at these things differently. Abortion, and this Catholic fund, it's any exposure greater than 0%. Maybe something different for tobacco, right? So they may own a company that has, between 0 and 5% of their profits in production goes to tobacco. So there's a little bit of ownership in tobacco production or sales in the Catholic fund, but the top few, they are very staunchly against. So each one of these mutual funds, each one of these managers has a different philosophy. So understanding that is partly our job and putting the portfolio together. This is the big question we always get asked. Should Christian investors risk lower returns to invest biblically? This study by Robert Netzley and his team at Inspire kind of puts to bed some of those questions and fears that people have, but it's a lot more complicated than that. I would say, should investors expect lower returns? No. Certainly there are market cycles, and different companies and different investment styles are going to be more successful in different points and different times throughout those investment and market cycles. But Christians and people who are trying to invest in a faith-based manner biblical responsible manner should not expect lower returns, because you're still investing in for-profit companies in the public markets, trying to make a profit, trying to do all the things that we talked about earlier, beating inflation, and growing those dollars for future use. So you shouldn't expect lower returns, but there are going to be different return cycles. 2022, the portfolio that we invest in a faith-based manner actually did a lot better than some of the growth portfolios, because there's the Magnificent Seven you probably heard about. Those companies were getting crushed, so they've roared back. Some of them have done really, really well. So there's just going to be cycles, as there are in any investing. So just understanding what you're investing in, why you're investing in it, that your return pro forma may be a little bit different over different cycles is something to understand, but you shouldn't expect lower returns because of that. But we get this question a lot. Slide here, I just want to talk a little bit more about who we serve and how we serve. We do have a priorities process, which is Concordia. We built this out. We think, again, from a planning perspective, that we are helping people by understanding their personal values, goals, and aspirations. So it's not just about investing, it's about financial planning in general, and really adding value as an advisor is not just how do I position my dollars, because again, I started with money as a tool to achieve your goals, achieve your priorities. It's not the be all end all to finding success the way that the Bible defines success. I'm going to pause there. I think that's my presentation. I know that we're leaving some time for questions. So I don't know if the moderator wants to take over, but went through a lot of material, and I apologize. I don't like monologues, but I wanted to get the material out there and really open the floor for what questions do people have.
Perfect. Thank you, Jordan. If you want to stop sharing, we could see everyone. And then, yeah, if anyone has any comments, questions, feel free to come off of mute. That was really great for me to listen to, though. I'm kind of in the process of, hopefully in the next year or two, getting a home and figuring out, what type of things that I want to invest in. I mean, I've been blessed to have my dad help, Chaz, and some other things, but it's good to know kind of what to avoid as a Christian, and really dig into each company's values, because I think sometimes we just go full ahead and we want to invest in what's going to make us the most money, but it might not align with our Christian values and faith. So I thought that was really great. Thank you.
Yeah, you're welcome.
Yeah, I like the so I have an app called Public Square. I don't know if anybody has heard of it, but I use it a lot now, and it's basically you have to apply. The business has to apply to get on it, and it's a pretty strict screening process. So that when you buy products and services through the app, that it's not going to be, your money's not going to be going to anything that contradicts biblical values and principles. And it was really neat because I was talking to a friend even just a couple of months ago about investing, and she was telling me like she needs to really look at her investments, because there's some companies that she knows that she is investing in that she knows doesn't align with her faith. So it's just really cool for you to show how to do that, and that there is a way to screen and still make, still invest, still get that return, but also know that you're not investing in companies that go against your values. So that was really eye-opening. I knew there was a way to do it, but I think the way you showed it was like, wow, there really is a way to do that and to screen for that. And so I appreciate that part of the presentation. It really opened my eyes to the fact that you can get down to the nitty-gritty and have a portfolio that honors God.
Yeah, Jeff, and I'll say, I mean, there's no perfect way to invest. One of the stories that kind of caught my attention early was the Hobby Lobby case. So they under the Obama administration, were being forced to provide abortives for their employees, their a privately held company, and they fought all the way to the Supreme Court with their own personal dollars, to fight against this mandate that came down, and they won. On the other hand, they were profiting from abortion in their 401k. They did not know that at the time, but it was 2018, I think, is when that was highlighted to them. And they made some changes to their 401k platform, and I'm glad they did. But all along the time they were fighting against this, so their dollars and their voice on one side were fighting against having to provide this service to their employees, and then they were profiting from it on the other side. So I think that highlighted to me, like, what are the things that I feel strongly about? What am I convicted about that I may be profiting from because I'm trying to get maximum dollars out of my investment portfolio that I might be personally against and using charitable dollars for fighting against, and why can't we just defund it on this side and continue to fight against it on this other side? So there's no perfect way to invest, but there are, again, I think, better ways, and I'm always still learning. Again, we like to educate and help people along their journey as well.
Hey, Jordan. Oh, I'm sorry. Go ahead.
You sure? It's okay.
Yeah.
Jordan, I really love the way you presented it, and just even I'm not near retirement right now, but even just thinking that way, that key point of outgrowing inflation is a key aspect of this. And you made it actually seem possible, which is awesome. But my question is more around what you and your company do. And if we wanted to, like you said, not fund certain companies that support these things, if we already have a Fidelity account that is kind of mutual funds and investing and growing, would what you're talking about be a separate investment journey, or can you look into our current Fidelity account and discern those things and help us use it better? Is it two separate things, or can you work together with Fidelity?
Yeah, that's a good question. So it depends on what type of Fidelity account it is, right? So if it's a personal investment account of Fidelity, then your investment universe is very broad and open, and you can invest in some of those mutual funds and ETFs and some of those companies that I talked about that are doing things in a biblical, responsible way. If it's a 401k platform through your employer, you may be very limited into what you can. Again, that's some of the constraints in the 401k space. Is that the employer chooses what funds there are in that lineup. So Fidelity is a big provider of 401k accounts. So depending on the type of account, if it's an investment account, in general, personal investment account, you do have the investment universe open to you on the Fidelity platform, and many of those faith-based funds will be on there. If it's a 401k on the Fidelity platform, you may be limited to how you can invest. You're welcome.
Hey, Jordan, great job. I really appreciate the rhythm of today, and it's always fun to learn. And it's a complicated topic, and you uncomplicated it. I had a thought on when it comes to bonds, the bond market. Like one of the avenues on bonds are like more of a tax aware kind of municipal bond thing like that as an investment getting older and whatnot. What's your, obviously from a big biblical standpoint, you're focused on a municipality, I guess, which would be roads and probably other kinds of resources, right? Water, roads, and like whatever they put into that stuff. But what's your thought of those types of municipal bonds that are, as far as the value of them and tax awareness and stuff like that?
Yeah, from a tax awareness perspective, it depends on the size of the bond portfolio. A lot of times we'll use individual bond managers to customize a portfolio for someone. The challenge with bonds, for years and years, is there's not a lot of money to be made there, and so not a lot of investment firms have put a lot of focus on bond investing over the years. At least in the last decade, there's been not a whole lot of money to be made there. There's more and more, and we do believe that bonds still have a place in the portfolio overall. With the Fed raising rates, there's all kinds of factors, specifically, to someone's planning, that how bonds fit into it. But there's certain, when you're talking about a biblical responsible investing, there are, like, the Praxis has a bond fund that invests in companies that are doing clean water. So they're taking on debt, and you're buying that debt and getting that fixed income return back from companies that are trying to provide clean water to people around the world. So there's positive bonds. Some of the funds, there's just not as many options on the faith-based side. But when you look at individual bonds and municipalities, like you were talking about, some people don't want to fund the government, and there's different people's views on whether they'll take federal debt or local debt and as an investment tool. So again, all these things become very personal to you, but being tax aware and utilizing the bond space for that tax-free income can be beneficial for people.
Jordan, this is Joe Lorenz. Hey, I'm involved with a group that's creating carbon credits in the market, and then there's a international market for the carbon credits. What's the overall strategy related to generating that? There's a lot of people that feel that's carbon credit offsets are kind of a bit of a shell game. What's the general thoughts there?
Yeah, that's a good question, Joe. We have used some of those more complicated tax strategies for some of our clients, the high earning clients. Carbon credits certainly can fit in that category. Solar farms and things that syndicated investments that we've used for some of our clients. We were talking more about public markets. I could go down all sorts of rabbit trails with that question, Joe, and maybe we can take that offline. But I'd love to connect with you and learn more about how you're doing that. But it gets into global warming. It gets into all kinds of stuff, and how much the government is involved in creating the markets versus capitalist markets that are created by supply and demand. So
yeah, we're in the middle of a fundraising right now and trying to pitch it in such a way that people immediately they seem to be very politically charged environment regarding this. So
yeah, that certainly is a fun one, and I'd love to follow up with you after this call.
Jordan, can you talk to annuities? What's your feeling about annuities?
Yeah, James, the phrase I usually speak to when speaking about annuities, we've placed annuities. We do not sell annuities. We're fee only, but we have placed annuities for some of our clients. I always say that they are sold to the wrong people, the wrong time, most often. So there are insurance salesmen that are usually the ones pushing annuities. But annuities, I do believe, have a place in somebody's portfolio if they need that guaranteed income. Want to give away an asset to create an income stream to cover some of their basic needs in the planning process. I do believe there are good annuities out there. Now, I mean, we tend to be in the fee only space, using very low cost, low fee annuities when we do make those kind of recommendations, and work with specific brokers that are in the RIA, or kind of the independent channel. Most often when you go to an insurance shop, you're going to get an annuity that pays them a higher commission. They have a suitability standard, which you've probably heard of. So they can look at two different annuities, like as if you had two different bottles of water, and they both are going to quench your thirst, but one's going to give them a higher commission or check back. Which one do you think they're going to give you? It's going to be the one that gives them the higher commission and check back into their pocket. So when we think about annuities, they do have a place, and we believe they have a place in somebody's planning and their portfolio, but don't tend to believe that they are offset to bonds, as many people try to sell them as. And again, they're sold to the wrong people at the wrong time for the wrong reason, and that using that sold term, because a lot of times it's a salesman that's presenting that to you, not a planner. Thanks for the question, James.
Anyone else have any questions or any ahas that they want to share before we go into close?
What about planning too, Jordan, in terms of helping people with financial planning, in terms of their goals, and actually helping with the accountability and the strategy? how much in the weeds do you guys get into that other than just managing the money?
Yeah, so we've set up our business to be a planning centric business, very different than the AUM model. AUM model being the assets under management. We believe it's important to ask how you get paid. We do have some AUM clients, but we typically have flat fee only clients. So we come to a planning complexity calculator on our website that you can put in your assets, you can put in your net worth and your income. And the first year fee, which is a trial period, is based on how much what we think your planning complexity is going to be, how much time and resources and the value that we're going to add on the planning and advice side of the business. So the investments, like I said, money, investments, those are important. And we believe that's a tool to help you achieve your priorities. But we have come to the business a very different angle than most advisors that you probably have spoken with. So we don't get paid from the investment accounts or on the investments. It allows us to also work with a wider variety of clients. At a previous firm that I worked for, we were told that the minimum account was $1 million, and at 1%, that's a $10,000 annual revenue or fee per client. We were quickly followed up with, you shouldn't focus on the $1 million clients. You should focus on those that have 2 and 3 million, because you do no more work for them and you get paid 2 and 3 times more. We didn't think as Christians that was a fair way to run the business. It was focused on money, again, as a goal for the business, and not focused on how do we actually serve people the way that Jesus intends us to. Thanks for the question, James. But planning is very important at any stage, so whether it's one-time plan put in place, or whether it's ongoing planning and advice that's needed, with some of Joe's expertise and carbon credits, it depends on the situation, how complex it's going to be. We think that they're, are basic, there's a lot of do-it-yourselfers, and we can kind of come alongside of them sometimes and give them, some advice and kind of make sure that they're pointed in the right direction. There's those that want the hand-holding and the accountability, like you mentioned, but we believe planning is really where the value is in any kind of engagement and relationship, where we actually help people.
Awesome. Well, if anyone has anything else, we will, Corey, thank you so much, Jordan, for your expertise and time today. I know we all took a lot away from this one, so thank you. We'll go ahead and close with what we have coming up. So some exciting things. So this is a Noble Live, so Noble Knowledge Live on Family, Faith, and the Future with Sherry Nash, and that's going to be Saturday, June the 8th from 9:30 to 11:30 at Oasis City Church. And there is a QR code that you can scan for that. So that will be an exciting live one. And our next Noble Knowledge Forum is going to be on cybersecurity with Logan Edmonds, and that's going to be on Thursday, June 13th from 11:30 to 12:30, and that's all via Zoom. So you can scan the QR code there. Then a way to connect with us on our social media. So we do have all the platforms here. So if you're not already following us, please scan one of those codes, get connected. We'd love to continue to stay in touch with you so you know everything that's coming up here with Noble. And lastly, we've got, so join the Noble Knowledge community, and then Hype Mail. So some more QR codes to stay connected. And I believe that's all we got for today then. So thank you guys so much for joining us this past hour. We look forward to seeing you on the next one, on the live, and then the next Noble Knowledge Forum. We hope you enjoy the rest of your week.